All right, so this is Chapter 8, and we're going to talk about recording and evaluating specific parts of the expenditure process. So really what we're going to talk about in this chapter for the most part is going to be inventory. How do we cost our inventory? How do we record it on our balance sheets? How do we come up with an ending inventory number? All that good stuff. So if you will recall, the expenditure process consists of the following steps. You're going to determine the need for the goods or service. So you're looking around and you go, okay, we have customers buying all of these cookies with M&Ms in them, and they buy them out every week, so we need to order more. Then we're going to select who we're going to order those from. You're going to select suppliers and order those goods and services. This is that requisition part, remember? And then we're going to finally receive those goods and services, and we are going to pay suppliers for those goods and services. It is important to note that these first 2 points, determining the need and selecting the suppliers, they're just business events, okay? They do not impact the accounting equation, and since they do not impact the accounting equation, we don't record them. The last 2 are actual accounting events. These are transactions. They do impact the accounting equation, and thusly they get journalized to the general journal, right? Remember, that's your chronological list of all the events that happen. And from the journal, they get posted to your general ledger. Okay, the general ledger are those T accounts. That's where we can find our balances very easily. Okay? So we do have to address really quickly before we get into maintaining inventory a couple of special accounts that we will have. So in a lot of businesses, you have transactions that occur all the time, right? So when I worked in the deli when I was a teenager, we just made orders of deli meats every single week. Like every Thursday, it was the day to order, and then on Sundays, the order would come in, and we would inventory, reconcile the bill of lading against the invoice that we got, and make sure we got everything, and we'd put them away. Since we did that so often, that's typically going to go into this temporary account called purchases, right? Instead of posting it directly to the inventory or directly to an expense every time or whatever the case is, we're just gonna record it in this account called purchases, and then at the end of the month, we'll add all of those purchases up and we will post it to the specific ledger it needs to go to, whatever it is, expense, inventory expense, bulk ham expense if you work at the deli, whatever the case is, okay? So some examples of that would be like cash disbursements, or you're dispersing cash pretty frequently, cash receipts, right? That's not like what you guys think of as a receipt, but when we say receipt in accounting, it means that we've gotten something, right? So a cash receipt would be us receiving cash. Purchases and sales, those are all kinds of special accounts, right? When you need specific information about the general ledger accounts, those are our sub-ledgers. We've talked about those in class several times. These are like you have your AR, your general AR account, that's your control account. And within that AR account, you're going to have Kyle's AR or customer 1's AR, customer 2's AR. Those are all subsidiary ledgers. Okay, they're just the individual accounts so that we can get the specific balances for those individual accounts. Okay. So, maintaining inventory records. This is what you think of when you consider going in and doing what they call inventory, right? You're inventorying. You're making sure that what you say you got is what you've actually got, okay? You are going to use one of 2 systems to track, maintain, and assist with recording and reporting your inventory. The first one is kind of the most common one. This is the one we see most typically, and this is your perpetual inventory system, okay? The perpetual inventory system is something like what Walmart uses, right? So you go through their self-checkout, you scan the box of cereal or whatever it is that you've purchased, it automatically gets removed from their inventory. And if you think about transaction number 7 that we looked at when we were going over chapter 7, right? That was we sold some amount of robots. Remember, we recognized the revenue and then we recognized the expense. That's perpetual inventory system. You're recognizing both at the same time. Okay. What it does is it maintains a continual record of the inventory on hand and the inventory purchased and sold. Okay. It really helps managers make good decisions. It's what we use the most often in practice. Now, this used to be kind of cost prohibitive, right? It used to be almost too expensive for everybody to use, and so only bigger chain stores would use this. However, it's becoming more and more common, and it's just kind of an easier way to track your inventory, more accurate way to really, you know what's on hand at any given moment. The other type of inventory record keeping is the periodic inventory system. This does not continually record inventory counts, and you calculate your ending balance at the end of a period based on a physical count. How many boxes of Count Chocula do I actually have on my shelf and in the store, right, or in the warehouse? Okay, you make an adjustment for purchases and sales of inventory at the end of the period. Okay, to correct your accounts. That is an adjusting entry you will make with a periodic inventory system. Okay. So really quickly, we'll look over an example of transactions for Mario's Game Shop. Okay, this is using a perpetual inventory system, meaning that every time they scan a product through their point of sale system, every time they sell something, it gets removed from their inventory. So here we've got a bunch of detail. You can see that on January 1st, they had a beginning inventory total of 100 units that they paid $7 a piece for. They had a total cost of 700 units, and we can just keep going down the list there. See there are some purchases, some sales, okay? And then at the end of the day, we can see that our total cost was $10,000 and our total revenue was $12,000. Okay, so let's look at this first purchase here. Okay, on April 25th, Mario's purchases inventory for $2,700 on account. That was 300 units at $9 a piece. Here we can see it's an increase to our assets, the inventory, and it's an increase to liabilities because we created that accounts payable account. Okay, there is no income statement effect, not yet. We haven't sold anything, right? We haven't paid for anything yet. So there's no expense and there's no revenue. Okay. The transaction here only involves the increase of increasing the balance of the inventory account, that's your asset, by $2,700, and increasing the balance of your accounts payable, your liability account, by $2,700 as well. Okay, so pretty simple transaction, not as complicated as some of the ones we've looked at prior. This is just recording an asset and recording that liability to remind us we have to pay cash for it in the future, and that cash payment will come later. So on July 17th, they're going to sell some inventory for $4,500. That was 300 units at $15 a piece, right? It's easy to find our cost of goods sold here, right? We know that 300 of those units cost us $2,500, right? We can go back and look. Okay. So here we can see it's an increase to assets. Why is it an increase to assets? We sold on account, so we're increasing our AR. It's a decrease in $2,500 to our inventory, which is another asset, okay? It was a $4,500 increase in revenue and a $2,500 increase in cost of goods sold. That's the expense. So we had a total of $2,000 increase in net income, which turned into a $2,000 increase in our retained earnings, okay? Just following the flow of the transaction. How did it impact our accounting equation? This is how it impacted our accounting equation. Okay. So this transaction really involves the recognition of revenue by increasing AR, increasing your sales revenue account, but at the same time, we're recognizing an expense. We're recognizing the cost of goods sold account, right? 100 of those came at $700 from our beginning inventory. 200 of them came from the $9 per unit purchase on April 15th. Totals $2,500 for our cost of goods sold. That is what we refer to as the FIFO method. We're starting at the top, that beginning inventory, and just peeling off layers till we get to the 300 that we sold. We will talk about FIFO more in another chapter. Okay, and then we're decreasing the inventory account by $2,500 because now we have $2,500 less inventory sitting on the shelf. Okay, so your journal entry would look like this. We're going to debit AR for $4,500, credit sales revenue for $4,500. Remember, these are increases to both of those. AR is an asset, so we debit to increase. Sales revenue is revenue, so we credit to increase. And then we got cost of goods sold. That is going to be a debit to increase. Remember, cost of goods sold is an expense, so you debit to increase the expense, right? And then you have inventory. Inventory is an asset. We're wanting to reduce it, so we credit it to reduce it, all right? We will pick this back up in the next video. Let me know if you have any questions.